So in 2026, more money is going to be invested in commercial real estate than in a very long time. So according to CBRE's United States Real Estate Market Outlook, commercial real estate activity is expected to increase to a total volume of $562 billion in transactions. Now, that sounds bullish, but that really comes down to two things. Number one is the easy bargains or the great deals, they're gonna go fast. And then the second half is gonna be the deals that you get stuck with that are very hard to get out of. So my name's Jeremiah Boucher. I own a firm called Patriot Holdings. I have roughly $400 million of commercial real estate assets under management. In this video, I wanna walk through the 5 asset classes that I would prioritize in 2026, and then the one rule I use for each of them, and then the 2-minute filter on how we underwrite the deal, or even if it's worth underwriting. All right, so let's get into it. Now, when I talk about these 5 asset classes, I'm not talking about you going on the internet or finding a deal easily. This is about being a dedicated sponsor or a dedicated investor that is grinding on looking at opportunities. These deals aren't gonna be prevalent right out in the open. They're gonna take hard work. So align yourself with a good partner, or if you're in the business, you know how hard it is to go out and scout a real deal. So asset class number 1, workforce housing. In 2026, as an investor, we want demand that's durable. Workforce housing is not a luxury, it's not a trophy, it's the housing that the majority of the United States population needs. That's why this asset class will be durable for decades to come. When I look at these deals, it's not about just finding a great opportunity either off market or in distress, it's about being a great operator. I follow and invest with one of the premier multifamily workforce housing investors in the country. His name's Bob Nichols. He runs a company called Monarch. They're out of Denver, Colorado. And when I get his quarterly reports, I am always blown away that this guy is on top of every single community. He scorecards every asset. He has forecasts that are right on the money. And he is excellent at what he does because he aligns every single regional manager, on-site manager, maintenance manager to all focusing on winning the goal and hitting the numbers that they project. And it's not about getting home runs, he's getting durable assets that cash flow out of the gate. And any way you slice it, workforce housing is undersupplied. We all know the cost of owning a home, the cost of any consumer goods, inflation hurts the consumer, the working class consumer. So we wanna check the rent to income reality. So I wanna study the supply pipeline on any market, and most markets are gonna be undersupplied, or the other competitors are gonna be such high rents that the workforce housing need is gonna be the highest demand. When I'm underwriting a workforce housing market, I wanna know there's jobs. If there's jobs, then there's people that can pay the rent, and as long as those jobs are gonna stay in the US and durable, then workforce housing is gonna be here for a long time. And then if everyone gets free income and robots do all the work, still, workforce housing is gonna need to be here for a long time. People need affordability. Asset class number 2, manufactured housing communities, also known as mobile home parks. In the old days, they were called trailer parks. This is a misunderstood asset class. Many people believe that they're low income, low rent, low desirability people in a community, and that is just not true. There's a large portion of the population that lives in manufactured housing communities. And when I talk about them, I'm talking about 100 or more lots that are near or in decent sized cities. I'm talking working class cities, and these assets are going to be here for a long, long time. One is because there's not a lot of supply. Economically, it doesn't work to build mobile home parks right now. The cost to build a mobile home park outweighs buying an existing mobile home park and improving the community. And like I said, these deals do not just hit the market, and when they do, they are extremely overpriced. Plus, there is a ton of skeletons in the closet, meaning water, sewer, power lines, all possibly have distress because these communities are 40 to 50 years old with their infrastructure. But the opportunity that they allow is people get a large yard, they get a decent sized house, and they get a very affordable rent because a land lease community, which is what the model of a mobile home park community is and for investing, is a place where people can pay off the home, they own the home, and then they just pay for a lot space. This is advantageous for families that are trying to buy their first home, especially in markets where housing is prohibitive, the cost of it, over $500,000 for a single family home. And then seniors also love it because they can own their home, they don't have any debt on it, and they have just a very low fixed rent, typically a third to half of what an apartment would charge. The one caveat I want to say on mobile home communities, since I know this asset class the best out of all five, is I've been in this industry 20 years, and the real deals are when you find them before they hit the market, and that is a grind. So my firm has been disciplined to call owners every single day, every working day of the year, and then talk to them, build a relationship, and then buy the community before an institution buys it, where they're going to raise all the rents, submeter the utilities, and maximize the value. So there's still a portion of these properties that are owned by baby boomers that are ready to exit because they still take management. That's hard work. And that's the opportunity. But unless you have a connection to someone that knows how to get the in before it hits the market, then I wouldn't buy a mobile home park that's just listed for sale by a broker. They are overpriced with lots of deferred maintenance and lots of management issues. All right, so the third asset class is industrial. Specifically infill and last mile and small bay industrial. I would target assets that are within an hour of a major MSA. That's where you're gonna have the most amount of demand, because distribution, manufacturing, pick and pack, 3PL, all of that is gonna happen near large population bases. And these types of businesses need industrial warehousing and distribution centers in these markets. So industrial right now, as of the end of 2025 and 26, is actually in a downturn. There's a lot of large industrial buildings over 100,000 square feet that are sitting vacant. But that leaves the opportunity where developers have held these assets for 3 years and still have not leased them. Friends of mine, I know them personally, that they want to sell the asset just to get out of it, to preserve their capital or their investors' capital and pay off their debt. That is where the opportunity is right now, because the cost of building has gone up over the last 3 years, and it will continue to go up, and the demand for space is still here. Amazon and every other drop shipping company needs places to distribute their goods. And then the other industrial asset class I like is small bay industrial, because it mixes retail, industrial, and office all together in one. That's why they call it flex space, flexible space for people to run a business. Nowadays, people want cheaper places to run their business. Everyone can't work from home. People need some warehousing or somewhere to park vehicles or to have a showroom. And then they also need an office and maybe even have a retail location where customers can meet them. This type of asset class meets that need. So this is an area I'm gonna focus on. And when we focus on these assets, one, we wanna be sure that the leases aren't too long. If they are long, then they need to be at market rent. You can get burned on industrial by low rents that extend out 5 or 10 years. Because if you buy a property, you can't breach the lease, and you're gonna have to honor that lease, and it's gonna prevent the asset price from going up. Also, we wanna look at the building functionality. So with industrial, nowadays, people are looking at higher clear heights. They want lots of loading docks. They want higher power, and they wanna make sure it's configured so that you can easily park or get in and out of the property. And these older buildings from the 60s, the 70s, even the 80s, they don't meet these requirements. So older industrial is a risk. Newer industrial after 1990 and above possibly can work, and that's where a lot of opportunities are gonna be available, as well as brand new buildings that are not leased up. But the caveat here is, if you invest yourself or if you're with a sponsor or a partnership, it takes deep pockets, because we don't know when the market's gonna shift, but having the capital there to wait until the timing turns when the demand is back for industrial is gonna be where the real opportunity is. And before I get into the next asset class, if you like to look at deal flow, if you analyze real estate deals, and if you want to see the insides of how they operate and the numbers behind them, then sign up below, click the link, and you'll be on our preferred investor list, where you will get the first shot at deals that Patriot gets, and some of the insights into how commercial real estate deals really make money. We do case studies on there, so get on the email list if you like deals, and I'm happy to share more in my private network. So asset class number 4. Necessary-based retail. I'm talking about grocery-anchored or service-based retail. 10 years ago, retail was dying. Everyone thought Amazon was gonna put them out of business, and it wasn't trendy, but yet buying habits have not changed. People need groceries, even if they order them online. Grocery stores are here to stay. Service-based retail and medical-based retail is here. You can't outsource it from China. You can't do it from home. So people still are shopping at retail, and we're seeing occupancy levels hit some of the all-time highs because there's a lack of retail supply. Over the last 20 years, not a lot of retail centers are being built, or if they are, they're in premium neighborhoods, class A quality retail, but there's still B+ retail that offers nice returns. Now, would I buy a completely vacant Kmart building or big box that's been vacated? That's a different animal. We like retail that is at least 50 to 70% occupied, where you can cover your debt and then all the lease up is cash flow. That takes a savvy sponsor, and it takes knowing some tenants or knowing the local markets and the trends of what the customer wants for their retail, but it is heavy in demand. So keep your eye on retail. I'm staying out of it because I don't have the bandwidth to do it, but I like the space. I got a lot of friends in the space, and it's here to stay. So the last asset class, and this is technically not an asset, but it is debt, real estate debt, senior secure debt, and this is a conservative investment. So this is for investors that don't want to be on the equity side where they have ownership or participation in the appreciation of the asset. This is where the investor is the senior position. Like the bank, they get paid first. In this particular part of the cycle where there's distress in real estate, we haven't seen it widespread as of 2026, but it's happening underneath the surface. This is where investors win, where sponsors, investors, they need access to capital. They're still not getting access to good quality loans, or their projects aren't finished. So there'll be private funds or private investors, private lenders that will lend on assets where they still have good collateral in the asset, they have a good borrower, and they have plenty of reserves, or there's cash flow that can cover their debt. So they typically look for yields between 8 and 15%, depending on the risk of the project. And they're gonna underwrite to the quality of the collateral. They want nice real estate assets with downside protection. They have real debt coverage and realistic assumptions for when the project's gonna be done in 1, 2, or 3 years. The good thing about investing in debt is if the real estate owner does not pay, the debt holders get the asset back. So if the leverage is not too high, which many debt funds won't go that high, no more than 65 or 70% of the value of the asset, then there's that buffer there where they can sell the asset as a foreclosure, get repaid with all their fees that they lost, and they're made whole. So investors love this if they want durable, consistent monthly income. Anywhere, like I said, between that 8 and 15%. So if you don't want to be on the risk side of investing in real estate, debt is where it's at. I invest in some debt projects. I offer some debt projects where we work with private money lenders. And in 2026, there's going to be more opportunities you're going to see that are going to provide high yields with safe return. Okay, so the one rule I have in looking at any deal, and a lot of my peers that are excellent at investing in real estate have a similar framing to this. The number one rule, the golden rule of real estate investing, is what's the edge? And when it comes down to meaning what's the competitive advantage in the deal, so there's typically two ways to look at that. Number one is that you have inside access to the deal. You found an inefficiently managed property, or a property that's not been exposed to the market, or it's just an inside opportunity because a bank, an attorney, a CPA, somebody's brought the deal to you, or you went out and found it, built a relationship with an owner, and you're buying it before it's exposed to getting driven up on pricing. And some people want to sell an asset, not deal with a broker or deal with a bunch of different buyers, and they just want to sell it and get their number. So I always want to know, what's the motivation? What is the edge? What is the inside access to the deal? And there's a story around that, some story. And that story is what's going to drive alpha, that meaning drive higher returns, where you spot upside, you know how to identify value, and then you have access to unlocking it. The number two edge is the operational advantage. Most people do not talk about this one, where you can buy a property at a relatively low return. But if you have a strong operational platform, which if you're a passive investor, you don't. But if you're working with a partner that runs a tight business, like I was talking about Monarch, or like myself at Patriot, where we pride ourselves on operations. We have 100 different employees that are running these assets, looking at every single detail. I can't tell you how important it is that this drives value. When you buy an apartment complex or a mobile home community at maybe a 6 or 7 cap rate, doesn't sound good, but with the right management team, maintenance team, marketing team, construction team, you can drive value. So management and operations, the management edge is tremendous, because this is the difference between stock and real estate. Stocks, it's a commodity, it's a financial instrument you can buy on an exchange. It's very standardized and it's very transparent. Real estate is not. It's a very inefficient market, and every property is a business. And investors in real estate many times get hung up on just buying a great deal, and they get bored with operating it. Or they get old and tired and they just don't feel like operating it. And that's where the advantage lies, but it's easier said than done. It takes so much work to work with hundreds, if not thousands of tenants, that are renting a storage unit, renting an industrial bay, living in an apartment or in a mobile home community. So the details and the management can drive long-term value. All right, so let's dive into the final part of the video. It's the Patriot 2-minute filter. So before you ever underwrite the deal, you want to save time, because great real estate investors look at thousands of deals and they buy one or two. So how do you look at thousands of deals and still have a sane life and spend time with your kids and keep good health and feel good? Well, you have to have a filter before you ever dive into a spreadsheet. So the first thing you want to look at is demand. And you got to be practical. Think about it in common sense terms. What is going to drive someone to want to pay rent here? And I've made this mistake so many times where I've bought properties that weren't in great locations, that weren't essential to the area, and they took a long time to lease up because there wasn't enough people in the market, they didn't make enough money, and it wasn't on a great location. And I've learned from my mistakes. And even if you do those things, it doesn't always work out in the short term if you catch the market at a wrong cycle, but at least it protects you where if you're in a market that has lots of jobs and you are on a very high traffic road with visibility, and if people need a place to live, if they need a place to work, meaning their business needs to have a location in order to serve the customers in an area, then these types of assets are going to be in demand. One thing I love is the destiny is in the demographics. So if there's enough people in an area, they make enough money, and there's a limited amount of space, there's going to be demand if you have the right type of asset. And these 4 different types of properties all serve that demand. So one simple way to look at it is just say, if I could never sell this asset for the rest of my life, would I want to own it? Will someone need this? My kids' need this asset if they lived in this town. And if that's true, then that's worth buying and there's demand there. All right, number 2, supply risk. The biggest enemy in real estate geographically is supply, and it's simple economics. Too much supply causes lowered prices. There's only so much demand that can fill up the supply, and we see this happen in real estate all the time. Austin apartments. Austin was the hottest market in 2020, and now is 2026. It is one of the most decimated apartment markets. Why is that? Because so many developers went into that market, they overbuilt, and now there's not enough people that can afford the rents on these apartments, so values plummeted, and now banks or investors are taking back these properties or having to sell them at discounts. I know personally, my friends, this happened to. So we want to look at, is there a constraint in supply? When you look at markets like Boston or New York or LA, there's only so much land, and you can't build on top of other buildings unless you knock down a building, but that costs a lot of money and that increases the cost basis. So I'm not saying you need to invest in these markets, and I typically don't, but where I do look is in suburban areas. There's zoning constraints, meaning that you cannot get the approvals to build this type of thing, or there's land constraints, meaning that the topography, the ocean, whatever around you will not allow for more development. Or there's pricing constraints where the price is too high and you can't go in and build an asset for less than what you're buying this next asset for, so it limits supply. And just like good old Warren Buffett said, every business needs an economic moat. So every property needs an economic moat. And if you could find an asset that is in a heavy residential area and there's density, there's not a lot of vacant land and not a lot of ability to develop, you have an asset you never want to sell. Last filter before you go into any spreadsheet is debt survival. Boy, oh boy. Debt is a double-edged sword. Trust me, I know. You can make tons of money with it, and you can lose tons of money with it. And in real estate, debt can be your best friend or your worst enemy, where leveraging property allows for outsized returns, but as soon as you lose income, meaning you lose a tenant or multiple tenants, or the market shifts and you have to lower rents, that is when you can't service your debt. When you can't service your debt, game is over, because you have to fund that debt as long as you can, and then the bank will take the property back and you lose your capital. So look for the debt buffer. And how do you do that before you dive into a spreadsheet? Well, you want to look at what are the current market rents and income now, and what are the forecasts for the future. If the deal, being a deal or a great asset, is predicated on raising rents and building more parts of the property, and you're looking for cash flow, then that's a risky endeavor if you're not ultra confident in that market. So what you really want to do is buy at a basis that allows you to lose 10% of your tenants or maybe more. Or you have enough reserves funded in the partnership to be able to withstand losing a tenant, and there's still enough demand to backfill it in that time before your reserves run out. This is how you focus on debt survival. So what I'm saying is make sure that the revenue can go down 10 or 20% and still be able to pay the debt. This is why I love multi-tenanted real estate, diversified streams of income, right? We have an industrial building, we buy small bay, we have 50 tenants at a property, or a mobile home community, we have 100 tenants. So on these assets, we don't have maximized rents, or if we do, we can still lower the rents a little bit and be more competitive than the competition because we bought it at the right basis. So the key here is you can lose 10% of those tenants, still pay the debt, weather the storm. You may not get a return, but over a long enough timeline, if you have a good property with demand, there's a limited supply, and you can weather the storm and pay your debt, you'll have generational wealth. That's what works. All right, to recap the video, if you're a passive investor that likes commercial real estate and you want to find good deals or work with partners that have good deals in asset classes that are going to go good in 2026, or if you're an active investor that wants to get into the business, here they are. So workforce housing. This is my favorite here. Well, actually workforce housing and manufactured housing. These two, affordable housing, are the best this year to focus on. And this isn't short-term profits where you get rich quick. This is long-term wealth. But you can buy right now, put yourself in a good position, look at it from a 10-year hold, and you will do very well if you want to hold these assets. If you're looking to buy and sell and flip it, it's not the right time, or it's not a durable strategy. Next, industrial last mile. This one takes capital. So if you have deep pockets or you're going to work with a partner that you can bring together a lot of capital, there is a ton of opportunity here in industrial, but you got to be able to hold it. If you can't hold it, you may lose it, like some of the people are losing it now in 2026. Retail. If you like retail, I like retail. I think it's still a solid asset class, but it's all about the leases and the tenants that stay in there. So look at the quality of the retail that you're buying, and I would gear towards A and B class retail here, not C, D class. This is going to be durable, and make sure it's in a heavy trafficked area, nice and visible, where generations from now, people will still drive by this building. And then lastly, if you're a safe, conservative investor, you want 8 to 15% yields that are in first position, real estate debt is a great opportunity to be a part of because you don't have to take the risk of owning the asset, and you get paid first. You act as the bank. All right, so I hope this video helped you think clearly about what to focus on in 2026. The next video is a natural follow-up because most of the time, the question I get is, okay, I bought real estate. What are the tax rules? What are the tax benefits, especially right now with the big, beautiful bill and Trump being in office? So I want to give you no gimmicks, no hype, just the fundamentals. What are the strategies, the tactics that smart investors use that are practiced by CPAs and tax advisors? So we're going to get into what to focus on, the essentials on tax benefits in real estate. See you next time.